Hey, accounting students. This is a video lecture for our last chapter of the semester, chapter 14, dealing with partnerships. And what I'm going to demonstrate here in this video and maybe a second video is the journal entries that we need to record for our partnership type business. But maybe before going through those journal entries, let's review the different types of business entities. And no matter what type of business entity you're dealing with, all businesses will have assets, things they own. And of course, we know our accounting equation equal to the liabilities the business owes plus the equity, the common stock or retained earnings. But let me add on here to the right side of the equal sign, revenue and less the expenses. So in the case of a corporation, what we had learned here in the equity section was the corporation's paid in capital, things like the common stock, additional paid in capital, maybe even less the treasury stock. Also, under the equity, we have the corporation's retained earnings. And now, no matter what type of business you're dealing with, like partnerships in our case here in chapter 14, or simple sole proprietorship, maybe you're planning to start up your own business, yeah? And you're going to probably be just a one owner business and maybe even a limited liability company. Again, no matter what type of business entity you are going to be using, all businesses have assets and liabilities. All businesses have revenue and expenses. What's different about different types of business entities is this equity section. And again, here you can see the different types of accounts for a corporation, paid in capital and retained earnings. But now, if you're dealing with a partnership or a sole proprietorship, a one owner, an unincorporated business, this equity section is going to be different. So before again we go into the journal entries, let's see how the owners and the business are related to each other. So let's go to a new screen here. So let's start off with our simple one owner unincorporated business. Again, that's called a sole or single proprietorship. So here's the business, and here is the owner up here. Again, we call him a sole proprietor or the owner, yeah? So the owner is going to be investing assets into the business. Of course, cash would be the obvious thing to invest, opening up a business checking account. And the business is going to be earning revenue and recording expenses just like any other business. Hopefully, it's going to get a profit, net income, and not a net loss. And this business could probably grow and expand and hire employees, maybe even family members working for this business. But the owner up here cannot be treated as an employee of his or her own business. When we pay employees, that's an expense here being deducted, yeah? Paying salaries or wages to our employees. But when you pay the owner, again, the owner of an unincorporated business, as we'll see also in a partnership, unincorporated, when you pay the owner, that's called a withdrawal or withdrawing or drawing. And that's not treated as the same thing as a salary or wage to an employee. Okay? A sole proprietor or a partner in a partnership cannot be treated as an employee for compensation purposes. When they take out money from the business, that's called a drawing. So let's go to what we know here for corporations. So the owners are called shareholders, and you could have dozens, millions. Here's our corporation. And like any other business, we have revenue and expenses, hopefully profits, net income. And when we have extra profits, we want to pay that to the shareholders. Of course, we call that dividends. Of course, you have to buy into the corporation or invest in the corporation, yeah? And in exchange, you get back stock. And in compensation, you can hopefully receive dividends. And maybe when the stock appreciates, you sell it at a gain. Our shareholder up here can also be an employee of the corporation. But you got to hire that shareholder as an employee. Yeah? Being a shareholder does not automatically make you an employee. So now when you pay that employee, that's going to be a salary or wage expense. When you pay that person in their capacity as a shareholder, that's not a salary or a wage. Yeah, that's a dividends, and we know we treat that differently than the payment of a salary or wage. Let's go to an example of a partnership that we're studying here in chapter 14. So here's our partnership, and by definition, you have to have at least two or more partners. So here's one partner, here's another partner. So the first thing we're going to learn in terms of journalizing here in chapter 14 is that each partner is going to contribute assets into the partnership. And eventually, when the partnership is profitable, again determined by revenue exceeding expenses, we're going to allocate that profit or loss among the two partners. But in the meantime, as we're operating our business, those partners here at the top need to get some money to live on for personal expenses. When you contribute assets to the partnership, of course, that's called contributions. When you take money out or any other asset out of the partnership to pay the partners, that's called again a drawing or withdrawal. This is not a salary, yeah, as we've seen like in the case of a sole proprietorship. What we eventually have to do though is allocate this net income among the partners, yeah, among the partners. Now, to keep track of all of these amounts coming and going, what we're going to do is set up an account for each partner. Yeah, for each partner. This is from the viewpoint of the partnership now. Yeah, in the partnership, we're going to set up a capital account for one partner and a capital account for another partner. Again, for each partner, partnership's going to have one capital account. So when the partner contributes into the partnership, we're going to increase that partner's capital account. When the partnership contributes an asset, we're going to increase that partner's capital account. When the partner takes a distribution from the partnership, we don't directly reduce the capital account, but what we do instead is keep track of those drawings for each partner. Here's the drawing account for partner 1 and the drawing account for partner number 2. Drawing accounts, just like dividends, we increase with debits. Increase with debits. And eventually, we're going to allocate the net income among the two partners. Now remember, when we allocate income, that's not money going to the partner. Money going to the partner is drawings, is drawings. When we allocate net income among the partners, what we're doing is increasing that partner's share, partner's interest in the business, increasing the capital account. So like we seen in our very first accounting class, at the end of the accounting period, we're going to close out revenue and expenses. You remember that account called income summary? The revenue income summary. The revenue goes in here, right side, and the expenses goes here in the left side, and whatever balance we have left over, hopefully a credit balance representing the net income of the business, is now going to be allocated to each partner here by closing out the income summary and increasing hopefully the capital account, increasing the capital account. Again, allocating net income is not the same thing as a drawing, not the same thing as a payment to a partner. Payments to partners are drawings. Yeah, are drawings. Allocation of net income among the partners increases their interest in the capital account. Crediting. So we're going to see the journal entries for all of this. So let's go back to our slideshow here. So the first journal entry we're going to see is partners contributing assets into the partnership. So let's take a look at an example already. So we have two partners, Carter and Green. And they're contributing cash into the business. So for Carter's contributing 50,000 and Green is contributing 20,000. Things are real simple when the only thing being contributed to a business is just cash. So we know we debit cash for the total. And for each partner, we got to credit their interests by the amount they put in. And again, the account that represents a partner's interest in a business is their capital account. Yeah, capital accounts is an equity account. Equity accounts are increased with credits. So in theory, if the partnership were to liquidate right now, Carter would get back 50,000. That's the balance in his or her capital account, and Green would get 20,000. Probably before you liquidate a business, and we'll talk about withdrawing partners in the second video. What you probably have to do is revalue the assets of the business and adjust the capital accounts. And that's, again, what they can take out in theory now out of the business. Of course, if you take out everything, that probably means that that partner is gone. That's less assets now left over in the partnership to run the partnership's business. Okay, so simple situation when the only thing is you're contributing cash. Now, this is not the same thing as sharing the income and losses of the business. In other words, Carter, because having more capital than Green, doesn't mean Carter automatically gets more income coming out of the partnership than Green. Yeah? All this is, what we're showing here, is in theory, what would the partners be able to take out if you were to liquidate the partnership? Okay. Let's look at our next slide. So now, same two partners, Carter and Green. Carter's going to invest just cash again, 50,000. But this time, Green, who has his or her own business, is going to contribute the assets of that business into this new partnership. And here is Green's costs, the so-called book value of those three assets. But what we're looking at, to be fair, is the fair value of those assets compared to the cash Carter is contributing. So we got to value each of these items upwards or downwards to get the total fair value of what Green is contributing into the partnership. So now when we record assets on the books of the partnership, we're going to have cash of 50,000 contributed by Carter, and these three assets at their fair value contributed by Green. Again, Green is not contributing $55,000 worth of assets. He or she is contributing $67,000 worth of assets. So that partner should be credited for $67,000 and not the costs. So when you look at the journal entries here on the next slide, here's the 50,000 cash being contributed by Carter. And then here's the other three assets being contributed by Green at their fair value. Also mentioned here in this slide, there's a mortgage liability attached to the building. And Green, of course, if he's going to give up the building, also wants to give up the liability, the mortgage on that building. So the partnership is now assuming increasing its liability for that mortgage. And you really are reducing the total value here Green is contributing by that mortgage to get now Green's capital credit into his or her capital account. And then for Carter, it's just the 50,000 contributed, matching the 50,000 increase to his or her partner's capital account. So in theory, if the partnership were to liquidate right now, each partner would take out whatever they have in their share of in their capital account, 50,000 back to Carter and 43.4 back to Green. Possibly we need to liquidate these assets and turn it into cash. And any increase or decrease compared to the values recorded here would be allocated among the two partners according to their profit or loss sharing percentage, which we haven't talked about yet. But again, in theory, whatever is in this capital account is what they get to take out if they were to retire or dissolve the partnership. Now, if I were Green and I don't want to give up my authority over the building, what I would do instead, see this land and building, if I were Green, maybe I would keep that building but rent it out to the partnership. As a partner, you can be acting with the partnership in different capacities. Like in this case, Green could be a landlord, renting it out to the partnership, collecting a rent, and eventually still keeping ownership of that land and building. But now, because Green is contributing that property to the partnership, if you were to again liquidate the partnership, Green has no 100% authority to get back the land and building unless they agree upon that ahead of time before they form the partnership. Okay, so there's variations of what you can do here when you're trying to form a partnership. Or even, let's say, Green, because of this big investment, gets a little bit more in the profits of the partnership. So almost like paying that partnership rent, even though he doesn't or she doesn't own that land anymore. So when you form a partnership, you may need to motivate one of the partners to become a partner because that partner is bringing more than their cash, more than the identifiable assets being contributed, something intangible value. So here in the next slide, what we're going to be looking at is this value being brought in by that partner, again, to motivate them to become a partner by giving them an additional ownership interest. And there's two different methods mentioned here. One is called the bonus method. If I can get my pen back. Let's make it my pen. The bonus method or the goodwill method to account for this intangible asset one of the partners are bringing into the partnership. So let's look at an example here. We have James and Joyce, and they're forming a partnership. James is contributing cash of 70,000. 70,000 by James. And Joyce is only contributing 10,000. But to motivate Joyce, who brings in her graphic artistic talents to the business, James is willing to give more than a $10,000 interest to Joyce. Now the total amount of cash being contributed is 8,000. And to motivate Joyce to become a partner in the partnership, James is willing to give half of this 80,000 ownership interest in the business to Joyce. Again, there's two different ways to account for this in terms of journalizing debits and credits. So let's look at the way called bonus method. Here's the 80,000 total cash. Again, that's 70,000 by James and 10,000 by Joyce. But when you allocate the ownership interest upon contributions, notice that they each get half. In other words, there's a $30,000 bonus being given to Joyce. That doesn't mean she gets 30,000 cash right away. Remember, this cash is just going to be sitting, working for our partnership. But now, in theory, if you were to liquidate this business right now, each would get 40,000. Okay? Again, ownership interest is different than sharing in the profit or loss of a business. Now, again, if I were James, I may not want to agree to this. Maybe instead, if the company is profitable, what we should be doing is allocating more of the profit to Joyce and less to James, because Joyce is bringing in all of that talent she has, maybe even some customers she's already have. Okay, but this is what James is willing to do to form this partnership with Joyce by giving a bonus to Joyce of half of the whole contributions by all the partners. So again, this method of recording the allocation of ownership is called bonus. Let's look at the alternative method called goodwill. So we know that, again, a total of, this is the journal entry for the bonus. Yeah? Again, 80,000 total cash being contributed, and we split that in half. Again, this is just ownership interest, yeah, not profit and loss sharing interest. So here's 50% and 50%. Let's take a look at the other method called goodwill. So we know James had contributed 70,000. Again, let me get my pen here. James had contributed 70,000 and Joyce had contributed 10,000 cash. So the difference of 60,000, if they're going to be equal partners, is this additional value that Joyce is bringing to the partnership. And under the goodwill method, we're saying now there's this asset, this value Joyce is bringing that the partnership has to record. And just like any asset, it's recorded with debits. You're debiting now a goodwill asset for that $60,000 difference in the cash contributions. So when you combine that with the total cash, here's $140,000 of assets. Accounting equation equal to zero liabilities plus $140,000 of equity. And because they're 50% ownership interest, again, not the same as profit and loss sharing interest, we split that in half. 70,000 to James and 70 to Joyce. Again, this is the goodwill method. You have to record a goodwill asset for that intangible value the partner is bringing in. We'll see this bonus method and goodwill method in our second video when we have an existing partnership admitting a new partner, or an existing partnership with a retiring partner. Again, bonus or goodwill methods. So partners can at any time contribute more assets to the partnership. Maybe the partnership needs more cash. Well, hopefully they have enough profits to generate cash, or maybe they can go to the bank and borrow money, open up a line of credit, or the partners can contribute more cash and be credited for that contribution by crediting their capital account. Here they call that additional capital contributions. Again, just debiting the asset, probably cash for the partnership, and crediting the partner who had contributed that cash or other asset. So let's talk about the partners taking money out of the partnership. Just like any individuals, you need money for personal expenses. But when you pay a partner from the partnership, that's not a salary or drawing. This could be the hardest working person in the business, but when you pay a partner, again, that's not a wage or salary. Partners cannot be employees of their own business. So when they get paid by the partnership, that's treated as a withdrawal or drawing. And here's the cash going out to the partners, crediting cash. And to reduce the partner's ownership interests, you don't directly debit the capital account that we've been crediting for contributions, but here we have drawing accounts for each partner being increased with debits. Eventually, these drawing accounts will be closed out, zeroed out into the partner's individual capital accounts, updating or really reducing the capital accounts. Now, you have to make sure that you're keeping enough working capital in your business so you can continue to operate. But if one partner needs more money, that may be putting financial pressure on the partnership. So you got to be really careful with whom you become a partner with. If your partner has a bad day, you're going to have a bad day too. So let's talk about the last topic for this video. Again, there's going to be a second video, but here our last topic is to allocate the partnership's income among the existing partners. Allocating income or loss. Partners can always decide among themselves how to allocate income and losses between themselves, among themselves. But you got to make sure everyone has a clear understanding and not just make things up as they go along. Also keep in mind when we're allocating income and losses among the partners, this is not the same thing as paying the partners. Again, that's drawings that we had previously covered. Let's take a look at an example here. We have three partners. That's Tinker, Evers, and Chance. And what they've invested so far in the business, like we've seen as capital contributions, is this 120, 90, and 75. It doesn't have to be the same amount. It always can be changing because partners are always maybe adding additional contributions or taking out withdrawings. Remember, eventually those are closed out, reducing the capital accounts. But now we're allocating income among the partners, which is going to be increasing these capital accounts. And the way they've decided to allocate the business's profit, here we're told at the bottom, it's $60,000 for the year. We're going to give 40% of that 60 to Evers here because of his or her business experience. And then the other two partners, 30% each. So 40% of 60, I think that's 24,000. And 30% of 60, that's 15, 18. Anyway, here it mentions that the partners also, each of them are going to take out 10,000. Again, drawings are not the same thing as income, yeah? There's 60,000 versus total here, 30,000 taken out by each partner, over the total of the partners for the whole year. So let's take a look at the journal entry here to record the allocation of this 60,000. First is the closing of the drawings. So they first had recorded the drawing. Remember that was debiting the drawing account and crediting cash. for each of the three partners, three separate drawing accounts. Now we close out the drawing by crediting the drawings and then reducing the capital accounts, debiting them for those drawing amounts. Then we allocate the 60,000 net income. So if you remember, revenue and expenses were closed out into the income summary account, crediting the income summary for revenue and debiting all the total expenses in the income summary, leaving a balance here that now we're closing out with a debit and allocating it by these percentages that they agreed upon earlier, increasing the capital accounts. So again, decreasing for the drawings and increasing for each partner's share of their profit or loss share and percentage of the partnership. So after recording those journal entries, you can see the ending balances here for each partner, their share of the partnership's income, their drawings during the year. Life would be so simple if you could use this method. Again, that 60-30% allocation, same amount of drawings. In fact, if you allocate the net income evenly between the three partners here, that would be even simpler. But life is not simple. What you want to do is reward the partner that brings the most value during the year and allocate more of that net income to motivate partners to work hard. So we'll take a look at an example here that does that by getting a little bit more complex in terms of allocating that, let's say 60,000 net income using something called interest and salary. Again, same partners, three partners, and what we're going to do is credit them out of that net income for the year a 10% interest on their capital account balance at the beginning of the year. Keep in mind that this capital account balance is each partner's investment in the partnership. Just like when you put money into a bank account, you want to earn interest. Well, here they're putting their capital into the partnership and they want some type of return on that investment. So what we're doing is giving them a 10% credit on that capital investment as of the beginning of the year. To make things a little bit more fair, really you should be doing a percentage of the average balance during the year. Because remember now, if a partner takes out a withdrawing during the year, that's going to reduce their capital balance. And that's not being factored in here if you're just using the beginning balance. Another thing to make things more fair is that Evers and Chance, they're going to be given $15,000 out of their partnership income during the year for the amount of work they put in. So really, the partner Tinker, maybe he's not even showing up in the office working. Yeah. So again, we're going to be crediting Evers and Chance $15,000 each out of the total partnership income, and nothing like this for Tinker. But then the remaining profit, if there is a remaining profit after the interest, after this $15,000 each, sometimes they call it salary, but again, you don't pay a salary or wage to employees. Anything left over is going to be allocated 3-4-3. That's 30% to Tinker, 40% to Evers, and 30% to Chance. Yeah, 3 plus 4 plus 6, that's 10. Yeah, 3 tenths, 4 tenths, 3 tenths. Again, that's anything left over. So here is the allocation. Starting off with the total net income of the partnership, we're going to give a 10% interest. That's 10% of 120,000 beginning capital balance for Tinker, 10% of 90,000 capital balance for Evers, and so forth. So that accounts for 28,500 of the 60,000 net income, leaving 31,500 still to be allocated. So now we have a compensation allowance. Nothing to Tinker, but 15 to each for Evers and Chance, accounting for 30. just leaving now only 1,500 left to be allocated among the three partners, which is 30% to Tinker, 40 to Evers, and 30 to Chance. Here, accounting for all of the 60,000 being allocated. So if you add up these three numbers across, that should equal the total amount we started off with. And as we've seen before, we zero out the income summary with a debit, and we now credit the capital accounts for each of the partners, increasing the ownership interests of the partners in the business. Let me stop here, and we'll go into a second video when we talk about adding in new partners or having partners retire. Each time that happens, technically, the partnership becomes a new partnership. But to the public, it's still the same business ongoing with one less or one new partner. Yeah, but we'll see how we have to record these new and retiring partners in the next video.